Hello and welcome to Investment Research. All right, let's get right into it. We're here to talk about Tesla, and this isn't going to be your typical hype piece or, some doomsday prediction. Today, we are doing a professional, institutional-grade deep dive into one of the most polarizing companies on the entire planet. We're going to cut through all the noise, look at what the biggest players, the smart money, are actually doing with their cash, and give you a real framework for understanding this stock.
So, as of late November 2025, here's where we stand. Tesla is trading right around $426 a share. But let's be honest, that price is just a single snapshot in time. Where it goes from here, well, that's the real trillion-dollar question, isn't it? And to even begin to answer that, we have to go way, way deeper than the daily headlines.
So, here's our game plan. First, we'll size up Tesla against the broader market. Then, we're going to follow the breadcrumbs left by the smart money. After that, we'll dive into the hard numbers from their latest earnings, pick apart Musk's grand vision versus the current reality, and then we tackle the elephant in the room, valuation. Finally, we'll pull it all together into a clear verdict and strategy.
Okay, let's kick things off with Section 1, Tesla versus the market. To really get a handle on this thing, you first have to strip away all the noise and just look at its raw performance.
Yeah, you look at this chart and you see, okay, Tesla's up a solid 26% year over year. That's outpacing both the NASDAQ and the S&P 500. And that's fine, but here's the thing. For a stock that's supposed to be a hyper-growth world changer, that's not exactly a massive beat, is it? The real story here isn't just the return. It's the insane roller coaster ride you have to endure to get it.
And that roller coaster has a name. It's called beta, and Tesla's is a whopping 1.88. In plain English, that means this stock is on steroids. If the whole market goes up by 1%, Tesla tends to jump almost twice that, 1.88%. Sounds amazing, right? But it's a double-edged sword. When the market turns south, Tesla falls nearly twice as fast. This thing is not for the faint of heart. It's a high-octane ride.
And if you want to see what that beta feels like, just look at this timeline. It is pure whiplash. The stock hits an all-time high near $489. Then, boom, it crashes a brutal 56% in just a few months. Then it nearly doubles off those lows. But notice, we're still nowhere near that peak. These swings aren't random. This is the signature of big institutional funds taking huge profits at the top and then aggressively buying back in at the bottom. This is their battlefield.
Which brings us right to our next section, following the smart money. Who exactly are these big players and what are they doing? Let's analyze the activity from the big institutions and the company insiders, because frankly, their actions speak way louder than words.
So first, the big picture. A massive 66.2% of Tesla is owned by institutions. We're talking mutual funds, pension funds, the works. On the one hand, that's a huge vote of confidence. This isn't just a stock for day traders anymore. But on the other hand, what's been happening inside that big block of ownership is telling a much more complicated story. The signals are pretty mixed.
So, in the buying corner, you've got the heavyweight champion, Vanguard. They recently added another 4.5 million shares. Now sure, a lot of this is just their passive index funds that have to own Tesla. But an increase this big still signals a core belief that Tesla is going to be a dominant market force for a long, long time.
And it's not just Vanguard. BlackRock also upped its stake. The key thing with a firm like BlackRock is that their active funds, the ones run by managers making real decisions, are buying too. That's not momentum chasing. That tells you their analysts have done the deep dive and believe in the fundamental story here, even at these prices. But it's not all buying, and this is a big one. We're also seeing some selling from ARK Investment Management, who have been maybe the biggest Tesla bulls on the planet for years. Now, this doesn't mean they've suddenly turned bearish. It's more likely just smart portfolio management, trimming a winner. Still, it's a critical piece of information. Even Tesla's biggest champions are taking some profits off the table.
And if we look inside the company itself, we're seeing a similar trend. Over the past 3 months, insiders have sold off about $75 million worth of stock. Now let's be clear, this doesn't look like panic selling. Insiders sell for tons of reasons. But here's the takeaway. We are not seeing them aggressively buying at these prices. We're seeing them cashing in some of their chips.
Okay, let's move on. Let's get under the hood and look at the company's actual performance. The quarterly earnings report. This is where the grand narrative meets cold, hard reality.
And the latest report was a classic split decision. On the one side, you have fantastic news, record revenue, and a mind-blowing $4 billion in free cash flow. That's a money printing machine.
But on the other side, they actually missed their earnings per share target, and more importantly, their operating margin got squeezed down to just 5.8%. And that's the central conflict for Tesla right now. They're growing the top line like crazy, but the bottom line profitability is getting weaker.
Let's dig in a little deeper. So, they delivered a record number of cars, which is great, but there's a big asterisk here. This was likely boosted by people rushing to get a tax credit before it expired. That pulls demand from the future into the present, and it creates a potential demand cliff. The real star of the show was their energy storage business, up a staggering 81% year over year. But the core car profit margins are still below where they used to be, and that free money from regulatory credits is shrinking fast. It's just a very, very mixed bag.
So, you might be asking yourself, if the current financials are so mixed, why is the stock valued so highly? Well, the answer isn't about today, it's about tomorrow. And this section is all about that bull case, the absolutely audacious, world-changing vision from Elon Musk that holds up this entire investment thesis.
And this table right here, this shows you the critical gap between that ambition and today's reality. The goal for robotaxis was 10 cities. The reality is about 60 cars driving around Austin. The goal for full self-driving is approval. The reality is regulators pushing back. The timelines are always, let's call them aggressive. So the core question for any investor is this just a temporary gap that's going to close soon, or is this a permanent pattern of overpromising? Your answer to that changes everything.
And that massive vision is exactly what leads us to the most debated, most controversial topic of all, valuation. Is Tesla's stock price a fair price for its future, or is it simply priced for a level of perfection that is literally impossible to achieve? Let's deconstruct it.
Okay, just look at these numbers. They're extreme. Tesla's forward PE ratio is around 232. For context, Ford is at 6. Even a super premium brand like Ferrari is only at 50. Tesla's market cap is bigger than the next 6 largest car companies combined. These numbers are astronomical, and they tell a very clear story. The market is not valuing Tesla as a car company. It's pricing in years and years of absolutely flawless execution on AI, on robotics, and on energy.
And this brings us to the two warring narratives, the two armies fighting over this stock. The bulls, they see an AI and robotics company that just happens to make cars right now, and they see a multi-trillion-dollar opportunity. The bears, they see a car company, period. A car company with shrinking profits, facing brutal competition, with a CEO who's, well, distracted.
Unsurprisingly, that deep division is reflected perfectly on Wall Street. Just look at this analyst's consensus. It's almost a perfect three-way split between buy, hold, and sell. And the price targets they range from as low as $19 to as high as $600. That spread is just absurd. It tells you that even the professionals have absolutely no consensus on how to value this company.
So, after all that, after the performance, the ownership, the earnings, the vision, the valuation, what's the verdict? It's time to pull all these threads together and create a clear, actionable strategy for how to think about this stock right now.
After weighing all the evidence, our professional rating is a hold. At the current price, the risk-to-reward profile just feels balanced. It's not cheap enough to get really excited about buying, but that long-term story is way too powerful to just sell. This is a wait-and-see moment, but you've got to have a clear plan. And here's that plan. Right now, we are in the hold zone, between $400 and $450. If the stock were to pull back into that 320 to 360 range, that, to us, looks like a strong buy opportunity. On the flip side, if it rallies back up towards those old highs, somewhere in that 450 to 500 range, that would be a signal to reduce your position and take some profits.
So what does that look like as a price target? Over the next 12 months, a target of $450 to $500 seems pretty reasonable. That's maybe 5% to 17% upside from here. But look closely at the assumptions. This isn't based on any moonshots. This assumes solid, but not spectacular, deliveries. It assumes margins just stabilize, they don't skyrocket, and it assumes no big robo-taxi launch. This is a grounded forecast.
Of course, no analysis is complete without staring the risks right in the face. The biggest one right now is that potential demand cliff. Then you've got the continued pressure on profit margins, the execution risk on all those big projects, and of course, the relentless competition coming out of China. And then there's the big one, valuation compression. The risk that the market just decides to stop paying 230 times earnings for the stock, which would cause it to fall even if the business does okay.
Which leaves us right back where we started, with the one central question every single investor has to answer for themselves.
Tesla's valuation is not about today. It's a massive, all-in bet on a very specific future. Is that a visionary investment in the next technological revolution, or is it a dangerous speculation with absolutely no margin for error? We've given you the framework. The final verdict rests on your conviction.